Right. Very good evening, ladies and gentlemen, and a warm welcome to the webinar on the Quest for Yield, which is our subject for tonight. I'm the chair of the Investment Analyst Society of South Africa, and this is part of their masterclass series of events which we hold from time to time, where we try and inform the members of the society, plus other people that are hooked into this webinar on an education of not purely company results, but just on a broader sense of getting to learn more about investment markets and opportunities. So welcome to everybody. We're co-hosting this event, the Investment Analyst Society, with ETFSA, which is a business that does everything to do with ETFs. And I must confess to wearing more than one hat, because I'm with IIS and with ETFSA, so I'll try and not do a Mad Hatter routine and just stick to doing my introduction. But we've been helped very much by setting up this webinar by the three participants, which are 10X, Portfolio Metrics, and Prescient, in putting together this webinar. And I think you'll find it very interesting and I think very enlightening in terms of some new opportunities that are coming to us as investors. Some of you might remember back in July last year, we hosted a masterclass on actively managed certificates and actively managed ETFs. And there was a big participation and interest in that. And the webinar podcast that came out of that has been viewed numerous times. So I think this is a subject of interest to a number of people. Where we're differing today on the July seminar is that there we focused quite a lot on AMCs, actively managed certificates. And today we're focusing much more on actively managed ETFs. And during the course of this seminar, you'll get to learn what an AM ETF is, perhaps relative to an AMC, an actively managed certificate. So it differs from that point of view. The other area of differentiation is that we're focusing on income. All the AMCs and most of the ETFs on the JSE are equity focused, but this is an income series of products. And income is not quite the same as fixed interest bonds. We know on the JSE there are South African bonds or global bonds that are available in ETF form. These are income funds, which is a much broader base of asset class of assets that you can pick within that income class. And by being actively managed, they allow the managers to move up and down the duration curve and looking for opportunities at the yield curve, or that different movements in interest rates and the markets might bring about. So I think actively managed income products, very popular globally, and they now come to South Africa. So this is very topical that we can bring this to your attention. The speakers will all be given 10 minutes or so to do their presentation, which they'll cover different areas of the market and perhaps talk a bit about their own products. And after that, we'll go into a general discussion, and all of this from once I shut up will be emceed by Nerina Visser from ETFSA, and she'll take us through the rest of the seminar. We do give you opportunities to ask questions. We really like the audience to pose their questions. If you look on the left-hand side of your screen, you'll see a little box for posing questions. And please make those questions available to us, and we'll pass them on to our speakers who I think would be very happy to answer those particular questions. The final thing I just want to mention is that for people who are of our financial service providers, who are members of the Investment Analyst Society, CPD points are available for the seminar. So listen closely and you'll get your CPD point at the end of the seminar. And I think it'll help you as well in terms of this time of the year when we're all looking for continuous professional development points. So the webinar will be recorded, so you'll still have a chance to follow this post the event. But I'd like to thank everybody for coming in on this webinar and for joining us. And if I can now hand over to Philip Bradford, who will be our first speaker. He's the head of investments at Portfolio Metrics. And so over to you, Philip, and thanks so much for joining us.
Great, thanks, Mike, and thanks everyone for joining us. It's quite an exciting time in the fixed income space because we essentially are close to the highest yields we've been since 1998. in terms of some of the fixed interest bonds that we're looking at. And what's quite exciting also about this area is a lot of what we invest in these portfolios, you can't access directly. They're all JSE listed instruments predominantly, but you can't actually access them easily as an individual investor. And that's what's quite interesting about it, but I'll unpack that as we go along. So I'm just going to talk just very briefly about the bond market in general. Bonds are sort of seen as the poor cousin sometimes, but the bond markets not only have been going a lot longer than the equity markets, but actually this is at the end of 2021 is actually showing them bigger than equity markets. I think equity markets might have come past them in the last year or two now, but over pretty much $130 trillion worth of fixed interest debt listed on the markets around the world. At the end of the day, though, bonds, I'd like to say, is a bit like a fruit tree, and equities are a bit like a forest tree, let's say. The key thing when you're buying a bond and a fixed interest instrument, it's all about the fruit. It's not about the capital growth. Where with a tree, it's more about the growth. And even when you get dividends from a tree, essentially an equity, just remember that those are branches that are cut off. They actually come out of your capital. So at the end of the day, I think just keep that in the back of your mind, and I'll unpack it a little bit later. The first bonds have been going back a long time. 2,500 or 2,400 BC. The first bond was a certificate found in Mesopotamia. Back then, the currency was grain. So essentially, someone borrowed grain and then had to pay it back over a period of time. Bonds became a lot more popular later on. The first sovereign bond was actually issued by the Bank of England in 1694. They raised £1.2 million to fund the war against France, and issued a bond at 8%, which is obviously an interesting number given where we are with interest rates at the moment. But just the history of it, most of the bonds that are issued around the world tend to be backed by government, but corporate credit has become a lot more important over time. Now, if we look at the South African fixed income market, this wagon wheel here shows you the makeup of about 4.6 trillion rands worth of bonds that are listed on the JSE. The grey area here are the government bonds. That is mostly fixed rate government bonds. There's a bit of inflation linkers and a very small amount of floating rate bonds, which I'll unpack again in a moment. But the colored areas here are what we would call credit. So in other words, not issued by government. The yellow area, and if I pull it to the side here, the yellow area are the parastatal or SOE bonds, which are still mostly government guaranteed, by the way. Importantly, they are also mostly fixed rate bonds. So the rest of the bonds on this wagon wheel are the other corporate credit type bonds. You'll notice it's dominated by the blue area here, which is the financial services bonds, predominantly the banks, but also the insurance companies. These tend to be the best quality and most liquid in that credit market. And it's the area in the portfolio we manage when we move outside of government type debt. We try and stick to the financial services bonds because there's a really good second-hand market in them, if I could put it that way, and they trade quite a lot. There's a lot of other corporate credit bonds out there as well, and more recently, a lot more credit-linked notes you'll see on this purple area. And credit-linked notes are largely repackaged government bonds predominantly, as well as and introduce a bit of a bank credit layer onto them. This has been the growth of this credit industry or credit area. You can see back from January 2010, it was about 350 billion. Now in this area, and this excludes the credit-linked notes, over 800 billion rands worth of bonds in this space. There was an enormous amount of growth around 2010, and actually from about 2006 onwards. There weren't a lot of corporate credit bonds when I got started in the bond market in the late 90s and early 2000s. Really, the only real credit bonds we could buy was Eskom, Telkom, a bit of Transnet more in recent years, and then some of the infrastructure type bonds. At one stage, Eskom bonds actually even traded a lower yield than governments because it was seen as a better credit quality. But essentially what you'll see is there's been a growth in the bonds, but a declining growth trend, I suppose. So there's been a big demand in this space. Now, what's happened over the last number of years is we've seen a large adoption of credit bonds or corporate type bonds that are floating rate bonds predominantly. In other words, they don't pay a fixed rate of interest, they pay an interest that moves up and down. And this has allowed unit trust categories to take advantage of this. So if you look here, your multi-asset income category, where this portfolio we run fits into, as well as the interest-bearing short-term, as well as the interest-bearing variable term, which are more your traditional bond funds. You'll see there's been enormous growth in these sectors over a period of time. In fact, they've been the only areas that have shown growth in terms of market share. There's over 800 billion rands worth of money sitting in those sectors, and that excludes money market instruments at this stage. And you can look from a share of your unit trust stats, the only sectors that have been growing have been the income category. The good news, actually, it's been giving pretty good returns to investors. And you'll notice it's come at the expense of something like your multi-asset, low equity balanced funds over that period. Now, bonds have actually been through a tough period. If you look at this chart here from 2012 onwards, the rand's gone from around 880 to the dollar to where it is now, and bond yields starting at 10 have gone out to some of the longer dated bonds at over 13% today. And bond yields at one stage, actually in April 2013, were around 6.75 was the average yield on the All Bond Index. Now, subsequent to that, we've had a serious, it's been a terrible time for bonds. It's been a terrible time for the rand as well. We've been through Nenegate, state capture, COVID, the recovery out of that, and then everything from the Ukraine crisis to interest rates shooting up with the inflation crisis around the world, and then more recently into the South African specific issues like the energy crisis, Phala Phala, Lady Russiagate, etc. Now, you'd be forgiven for thinking this would have been a terrible time to invest in bonds. And this is actually when we started the strategy, which we manage now in the ETF form. We run it in a unit trust form. We've been running that since July 2015. And we've kind of caught all of the worst of the market right between the eyes. The irony is, though, is actually bonds have done pretty well. And if you look at bonds, and this is going back from 2003 onwards, this has been the income that you've received out of the All Bond Index over the period. This has been the capital movements. And then these little bars that we're bringing in now is actually the total return. Because really, at the end of the day, like the fruit off the tree, what you get from a bond is the income. And you can see that actually your returns haven't been that bad, even with a bit of capital volatility. Now, interestingly, because you're able to reinvest your coupons at higher yields, bonds have actually given you a return of about 493% from the end of 2002 to the end of last year as well. But you can see the capital is actually down 15%, but the income dominates the return more so than you would out of the equity market. Now, a lot of people say to me, well, that's all very well, bonds have done well, but how did they do in dollars? Well, if you look at US treasuries in rands, in other words, including the rand appreciation, this is the return of US treasuries from 2001 to the end of last year. You can see over 500% return off 100 rand base. Interestingly, South African bonds have beaten US treasuries in rands, in other words, with the rand appreciation by over 100% over that period. And the important thing to understand here is that global assets come with a much higher degree of volatility in rands. So in other words, the weight of the interest has allowed bonds in South Africa, despite going through a tough period, to still outperform global assets, but at much lower volatility as well. And if we look at the portfolio we've been running since 2015, if we look over that period, that's what US treasuries have done in rands. That's what the bond market's done. And that's what the portfolio that we've been managing has done over that period. And the key thing to understand here is that the All Bond Index is very narrow. It's only got 20 bonds in it. It's the almost entirely government guaranteed exposure. There's a tiny little bit of first rand of nearly less than 0.5% in the portfolio, but it's really based on government bonds. So if you look for opportunities wider than the All Bond Index, you actually are able to show decent outperformance, but not only that, but with less volatility as well. And this is just really by introducing some of the bonds issued by the banks that are very hard to buy in your personal capacity. Any of you who've tried to trade and buy and sell the corporate bonds in South Africa will know that the liquidity is not really there. It's an institutional game. So the opportunity set is much wider. And then if we look at it comparing to some of the other asset classes over this period, this is showing the South African bond market. That's the total return over that period. That's the Cap Swix, actually. Sadly enough, which, as we know, has been through a tough period over quite a long period of time now. This is nearly 9 years. That's where property was. That's where inflation and cash was. And that's when that strategy's come through here. So even inflation-linked bonds, ironically, that provide you a yield above inflation have actually underperformed inflation over the last 9 years, where your multi-asset income funds have actually done really well. The bond market's done pretty well. And then our sort of track record in terms of what we've done has provided another 30-odd% above that. So really what the thing to understand with South African bonds, this is showing the major government bonds, and this makes up the majority of the All Bond Index. These are the yields currently, and this is the term to maturity of those bonds. So from anywhere from the 2026 maturity out to the 2048. There's now a 2053 bond, but it's not in the index as yet. And then this is showing the average, well, the weighted yield. So in other words, the market cap weighted yield of the All-B sits around here at the moment with an average term around 10 years. That's the yield of our ETF at the moment, sitting around this level, around 12.5% actually. And this is the yield and the term of a lot of all the different bank type bonds that you can get. The senior bonds, the tier 2 bonds, the alternative tier 1 bonds. This is the average of those yields across all the different bank bonds that we can see at the moment. But what's important to understand with the bank type bonds is because they're floating rate bonds, if I show this with using duration, here's the duration of the government bonds and the duration of our portfolio at the moment. So you can see a higher yield than the All-B with less duration. But this is what the duration of a floating rate bond looks like. It basically behaves like cash most of the time, unless you see a spread movement. So the yield on these bonds here at the moment, because they move up and down with interest rates as interest rates change, you don't pick up capital volatility. And what's very useful about this, by combining the floating rate bonds with the fixed rate bonds, we're actually able to generate a portfolio that's giving us a nice high yield here, but without as much volatility as you would get out of something like the All Bond Index. And really the thing to understand here is that, and this is the paradox of the South African market, is your most liquid, best quality assets in the country are the government bonds. There's enormous liquidity compared to anything you would see in the equity market. It's a bit like our Forex market, incredibly liquid. Importantly, they are more volatile because they're fixed rate bonds. If you want to reduce your volatility and you go into the credit rate bonds, you lose liquidity, and you take on more credit risk. So ironically, the least volatile assets in the country are actually to carry the highest credit risk, as we've seen in the market over the last couple of months as well. And that's quite an important thing to understand about the South African market. It's different about South Africa to most of the rest of the world. So the bond market's changed a lot. If you go back to 2008, going to 2009, the repo rate was 12, but the longer dated bond yields in early 2009 were 5% below cash. We've now got a situation where your 20-year fixed deposits, that's really what a bond is, it's like a glorified fixed deposit, is giving you about 5% higher than cash out of the longest dated bonds. Importantly, if you buy bonds going into a rate cutting cycle, you tend to do well. And this is showing how much returns you tend to get if you buy bonds going into a rate cutting cycle. And you can see that you pick up about 1% a month. And basically, it's important to understand you need to buy and fix your interest rates ahead of interest rate cuts. By the time the interest rates come, it's too late because it gets factored into the market very quickly. And what's important to notice as well on this slide here, this is showing the returns of your income funds in a rate cutting environment. And what you'll notice is that because the nature of a floating rate instrument tends to, the rates basically will move about 3 months after, will follow interest rates downwards. So we saw them following interest rates up during the last rate hiking cycle, but we'll see those traditional floating rate credit instruments will start, as interest rates start coming down, will start reducing their yield as well. Now,
Philip, if I may, I think this is a great point to stop you in terms of what you're doing, because I think you've just sort of given us of what's to come next. I'd like you to hold on to these last few good slides of yours, and I think during the Q&A session, I think that would be a great opportunity to go back to that. And I'm going to make you go back to your bull and bear scenarios, because I think those are excellent. But I'd like to give Henk Kotze, who's head of cash and income at Prescient, an opportunity, because I think he expands somewhat on some of these topics that you've got. You focused a lot on still government bonds, some bank paper and so on, but I think Henk is introducing some additional aspects that we can look at. So Phil, if I may, with your permission, please, if we can hand over to Henk now, and then sit tight, Phil, I'm coming back to you during the Q&A section. Thanks, Henk. Over to you.
Awesome. Thank you, Nerina, and thanks, Phil, for that great intro into what it is we really do on a day-to-day basis. We often sort of quoted as the boring guys in the market, but I can assure you that that's not the case. So thanks for listening. And what I'm going to do after Phil's given us sort of a very sort of higher level view of the sort of fixed income market in South Africa and globally, I'm going to focus more on the multi-asset income category. Look at the sort of tool set we have to use to get to our return objectives. Focus a little bit on risk as well. I think that's important given the sort of current context and the volatility we've seen. If you look at bond market volatility sort of surpassing the equity market more recently, it's important to focus on that as well, and then finish off very briefly on our proposition in the income space, which is the income provider portfolio. So without further ado, let's dive right into it. So what is this tool set I'm talking about? So from an income fund perspective at Prescient, we see the objective as a sort of CPI plus type portfolio. So for us on the income side, we're trying to target CPI plus 3. So that's our real return target. But most importantly, when it comes to an income portfolio for us is on the risk side. So there, our strategy specifically is to target to not lose money over any 3-month period. So it's quite a short sort of capital preservation target and something that we're very, very surgical about. But for us, really, the objective behind that is to get to generate and compound positive real returns. It's no point in finding yourself with a 5% drawdown in the income fund with clients and certainly investors in our portfolio that want to draw that regular income. So what is the toolkit we have and the sort of opportunity set or subset from what Phil's explained to us on the fixed income side when we focus on the income side of things? This is really it. So what we're looking at here, all the different silos at the top.
Sorry, Henk.
Yes.
I'm sorry to interrupt, but we're actually not getting your screen sharing. Won't you please? That means that the audience is unfortunately flying. Yeah, there we go. It looks like it's starting to come through. That looks a lot more promising. Keegan, if you can just from a technical perspective confirm that you can see it all okay.
All good?
Right. I think, Henk, we'll stop you if necessary, but I think, thank you. Thanks, Henk. You can continue.
Apologies for the glitch, ladies and gentlemen. So as I was saying, so on the opportunity side, we're looking at the silos at the top. So all the different drivers of that real return that we've been talking about, but they all grow out from this risk management layer. So nothing that goes into our portfolio would find its way into the portfolio if it's going to breach our target of not losing money over 3 months. So what are some of those opportunities? Phil took us through certainly on the duration and curve side. So on the income side of things, when looking at multi-asset income, we don't have a term nor a duration limit from a regulatory perspective. So we can play the whole universe. And that's very important to understand because we can go very, very front end money market, but also we can go back out to the back end of the bond curve that's got a bond that matures in 2053. And that's all part of the toolkit. So how do you construct a portfolio using all these different tools with all the different risk levers is quite important. And I'm going to show you how we do that, certainly on the Prescient side of things, when we get sort of closer to the end of my 10 minutes. The second part is the credit component. Phil went through that quite nicely as well. For us at Prescient, it's very important to understand 2 things when it comes to credit. Certainly a very, very interesting opportunity set for us, but you need to have a team that can understand credit, that can analyze the credit, and certainly understand the risk you're taking versus the price you're getting paid. So on the credit side, traditionally what people are scared of is what we call default risk. So that is if we lend our money to MTN goes bust, we don't get our money back. But more importantly, in the South African context, for us at Prescient, what's important is to understand the price of the credit. And that's really what we mean when we talk about spread. So how much is the counterparty, the bank or the corporate paying us on top of the JIBAR rate? And that's the spread component. That's really the price of credit. If that spread moves, your position in that credit is going to move as well. So very simply, if you take a 5-year first rand bond, it's trading, so let's call it 2% above JIBAR. If that goes back to around 3% above JIBAR, you will lose 5% in that position. Okay, so there is capital movement in credit. You just need to understand where the pricing of the spread is relative to the risk we're taking. And there we do obviously quite a lot of work. Going down the spectrum, we can use derivatives. So derivatives are an interesting sort of category in the income space. For us at Prescient, it's more a risk management tool. So we are able to find ourselves in some currency exposures. You can do bond sort of optionality and swap and fraud trades. But really, it's a very efficient way for us to, when we're taking on duration on the portfolio, to hedge that out or when there's currency exposure, to also think about positioning in the right manner for us. Real versus nominal. So here we're just thinking about opportunities, inflation linked versus not. But interesting in this space, and certainly what we do at Prescient, on the real side of things, there's opportunity in more the unlisted space as well. So renewable energy, as an example, we run an internal fund at Prescient. That's a clean energy portfolio. That's a CPI +6 portfolio, government guaranteed, about 30 different projects underlying. We've generated about 4 stages of load setting. It's a fantastic portfolio. Again, if you size it correctly, you understand the risk you're taking. It's a very nice tool for clients in a multi-asset portfolio to generate that return within that sort of risk framework. So in the real versus nominal space, that's certainly something we look at. Preference shares and property, the next sort of category as well, for multi-asset income. Interesting, both of those categories. Preference shares, mostly really the banks. So if you think about the preference share market in South Africa, has been dominated by the banks. They've been buying them back. So pref sort of falls outside of the ambit of Basel III. So it's what we call old style capital, and banks are buying them back. So probably a dying asset class. But interestingly, when you think about the capital stack, Phil mentioned the alternative tier one. It's additional tier one bonds of the banks. That's sort of a replacement for prefs, something called Flax coming to market. So the opportunity set in that space is certainly is not lost. And the ability for income funds to play that space is certainly still there. Property, that's an interesting one for us at Prescient. Income funds can get involved in listed property. But if you're thinking about a risk sort of portfolio, property unfortunately has those very sort of left tail events. If you think back to COVID, down 65 to 70%, if you look at the SAPI, you need to size that position and be really bullish when you're entering a position on the property side. But in a long run for an income fund, it's a fantastic asset class. If you think about sort of the inflation plus nature of an income fund, you think about your building cost, your asset that's got inflation sort of hedge, if they're paying you a dividend yield on top of that, it's a great asset class. So don't throw it away. Just really understand the volatility that's going to be introduced to a portfolio when you add some property to it. And then finally, we put it last, but certainly not last from our perspective, is the offshore component. So multi-asset income does have the ability to go offshore. At Prescient, for us, it's a yield play. So when we buy offshore assets, we always hedge out the currency to try and take advantage of that interest rate differential. Phil very nicely showed how our bond market has outperformed. For us at Prescient, we do think you get paid for being in South Africa, and we want to harvest that premium. And where we take currency exposure would be on the derivative side. So on the offshore side, a lot of interesting opportunities to buy dollar sort of income assets and hedge out that currency and create a very nice rand-based asset that gives you that CPI plus component. So that was a sort of whirlwind tour of the tool set. But maybe if we can, let's just dive into one or two of these and give you a better sense of some of the things we would need to think about from an actively managed perspective in this category, being as sort of diverse as it is. And then we'll end off with some risk ideas. So just very briefly, what we're looking at here is the current sort of pricing for the South African market. So what is the market telling us? Where's interest rates going? And sort of the topic of today's discussion, the quest for yield. Well, the truth of the matter is there's a lot of yield to be had in the SA market. So we're all very fortunate in fixed income investors. I mean, Phil's 12.5 income fund, we're closer to 11. There's a lot of yield to be had in the portfolio. So what we're looking at this in sort of this instance, unfortunately, from a private perspective or personal perspective, rates doesn't seem to want to come down anytime soon. But for us, sort of in the income side of things, this is sort of a good news as the continuation of the Goldilocks period for us on the fixed income side. So what we call this is at the very front end of the yield curve. So now we're really looking at sort of 2 years as part of the yield curve that we have to think about when managing a portfolio. What we can also do is to sort of expand that view and go into what we call the belly. So just here, we're focusing on the 3-year area. And what I want to show you is just the difference between what's priced for the 3-month area and the 3-year area of our SA yield curve. And let's just look at the spread between the two. And you can see, very interestingly enough, we're not really getting paid in the 3-year area a lot more than the 3 months. So from a risk return perspective, in our view, unless you see a very deep cutting cycle, there's very little opportunity in going into sort of the 3-year part of our yield curve. Just to give you a sort of sense of how granular one can get. And then finally, if we think about the back end, Here we bring in our sort of bond score, or our bond view. At Prescient, being very systematic, we break it down in different factors. You can see we are moderately positive, but what I want to show you here, and what's important to understand, and Phil again very nicely sort of positioned that, that bonds don't just give you the yield that you buy it at. There's certain components that a bond give you because of the shape of the yield curve, because of the price it trades at, etc. That's going to give you above and beyond that yield that we're looking for, that quest for yield. So what we're looking at here is our estimation of the current yield curve, the bonds that we have to invest into, and what we expect to return from them or earn in the next 12 months. And you can see, I mean, these are very, very attractive sort of expected returns for the different bonds. And then you could argue and say, but you're too bullish, you're putting on too much of a yield compression here from a sort of return expectation perspective. But if we break it down and we actually go and see what is that made up of, you can see the vast majority, this is the green bars, is made up from the carry or that coupon or income that Phil showed us at the start. So high yields are still very attractive. The roll effect, the steepness of the yield curve, yes, and some bullishness that yields could come down, all really going into the pot gives us a very good sense that bonds, certainly for the next 12 months, is going to give you equity-like returns, if not better. Okay. So the question then becomes, how do you put all of this into a portfolio? And my screen just froze. There we go. I'm back. And just very briefly, what we try and achieve and trying to get right at Prescient is to give a sense of what we expect to return or earn for the different assets that we can buy, because it's a very wide subset of tools, and that's why having a manager that's active is very important in this space. So what I'm just going to do is give you a very quick sense of how we can manage this, and this is just giving the optimization some restrictions. So that's a 50-year term to maturity, just to give us the whole universe. I'm going to give it a 1.6-year duration. That's our current duration in the portfolio. If you exclude our IRBs, any instrument can again be 50 years, and we're going to run this. Let me just shift my own face using our total return expectation. So all we're doing now is we're going, what is this universe that we can invest into? What's the best way we can position a portfolio, given our views, given our expected returns, and given this sort of subset of opportunities that we see? And what you can see here from this first chart is basically that same yield curve that Phil showed us, just expressed on a total return basis. You can see the sort of concentration of credit at the front end. But what is this optimal portfolio that we're talking about that gives us about 11% yield? And very interestingly, if we go down and we drill down into it, you can see that it wants to, in the 3-year space, buy floating rate notes. And that makes sense if we think back to our swap that I showed you in the 3-year space, that there's not a lot of risk compensation by fixing rate there. You want to be floating, buy bank credit, a little bit of yield on top of the JIBAR, and just float with the market. And when you're sticking your neck out and buying some duration, it's liking the 20-30 bond. So from a total return of expectation, bang for your buck, that's sort of the area that we think at this point in time for the income funds makes the most sense. Okay, so that's just a very whirlwind tour of how we would construct a portfolio. And then just
Henk, I'm going to have to cut you off here. Otherwise, poor Anton is not going to get a chance to say anything. So again, hang on to your thoughts, because we're going to come back to you later on again. But I think what you've done really well is to illustrate to us how an actively managed strategy can actually add an incredible amount of value in the fixed income space, in the yield space. And so I'm going to hand over to Anton to take us through the last part of our formal presentation parts. And Anton, if you would please maybe just start very briefly with this idea of an actively managed ETF. And I think in particular, Henk, you also alluded to it, that it's quite difficult for ordinary investors to buy exposure to these type of opportunities that are there. And the actively managed income ETF gives you exactly that opportunity. So Anton, over to you, and then we're going to come back to everybody. So I want to remind everybody also, any questions that you've got for our 3 panelists, please, top left of your screen, pop those questions in now, and we're going to come back to it as soon as Anton has shared his presentation with us. Thanks, Anton. Over to you. Thanks for bearing with us. Anton is still having some technical difficulties, so while the back end is trying to get Anton back on board, I'm going to try my very best to do a stand-in for Anton. Fortunately, we do have his slides. And Anton is really going to start by just really giving us an overview of actively managed ETFs. This is a topic that has been covered previously by the Investment Analyst Society, so I'm going to be quite quick through these, but really just to sort of focus again, most of us are familiar by now with the overall benefits of ETFs, the fact that they diversify, that they give you the low cost, that they're transparent, and that they're highly liquid. But the introduction of actively managed ETFs, which is something which has been available on the JSE for almost a year now, really introduced a whole lot of new opportunities within the ETF industry for us. And I think one of the biggest departure points is the fact that these no longer need to explicitly track an index. The underlying fund is still a CIS fund, a collective investment scheme, and that's why they are called ETFs, as opposed to maybe the AMCs, the actively managed certificates that was covered by a previous Investment Analyst Society event. So the ETFs, the actively managed ETFs, are still an underlying fund that you are covering. And the underlying transparency to that fund can either be completely transparent or it can be semi-transparent. So I'd like you to think almost in terms of a more traditional actively managed unit trust, but which is now available to the investor via the stock exchange. So the units in that actively managed ETF is now what is listed on the stock exchange and that one can buy. So the 10x Income ETF, the actively managed one, was the very first one to list on the JSE. It was back in May last year, so almost a year now that we've got a track record already. And nowadays we've got 7 of these actively managed ETFs. And in fact, the 3 speakers tonight all are representatives of one of these actively managed ETFs, specifically in the income space. So when we're talking about income actively managed ETFs, both Philip and Henk have given us some really good insight in terms of the opportunity set within the fixed income space beyond what would traditionally be captured through things like government bond indices or all bond indices, by looking at alternative sources of credit, perhaps different places on the duration curve and so on. And it really gives the fund manager the ability to capture a lot of this additional benefit in an actively managed fund. So when we look at the income AIM ETF as it is now, you'll see that they also, so 10x in this particular situation also moves beyond predominantly South African bonds. So Henk had alluded to it, and even Philip also indicated that obviously there's also an opportunity set in global markets. And what they do on the 10x side is that they do actually incorporate some of the global interest-bearing investments in this income ETF as well. But I do think that the opportunity set that 10x restricts themselves to in large extent is that their focus is very much on delivering a very specific inflation-adjusted return target. And it means that you will find in their portfolio, the biggest holding, as you see it there at the moment, inflation-linked bonds. Something that both Philip and Henk alluded to, but predominantly their portfolios do not make use of a lot of inflation-linked bonds, whereas in the 10x Income Fund, they do make use of a lot of inflation-linked bonds. And it's really because they are specifically interested in capturing what is currently available within inflation adjustment. We're going to come back to their specific strategies shortly, but really just looking at that global spread, the credit spread in particular, is the area in which 10x is capturing a lot of this opportunity set. Because what they are doing there is that you have the ability to get exposure to very deep, liquid credit markets in global markets, something which is a lot less available in the South African market. And so when we look at the type of offshore exposure that 10x includes in this portfolio, their offshore exposure is almost exclusively in the high yield space, in the credit space. And you can see that credit pickup that they have in the global credit market compared to the South African credit market and what is available there. So who typically uses actively managed ETFs? Who typically would be the biggest users of these? And we're seeing a growing range of investors coming from not just the retail space, but we're seeing certainly intermediaries, financial advisors, DFMs also increasingly using this. Have we got Anton back on board? Great stuff. So Anton, I tried my best to impersonate you. I hope I did. I got up to the point where it's just ready for you to now start talking about the 10x Income Fund itself. So I think you did that on purpose.
I heard the last 2 minutes of that, and it was brilliant. So why don't you?
Was that okay? Okay, cool. Well, I'm very happy to pass the baton back to you, Anton. Thank you very much. Over to you again.
Yeah, sorry about that, everyone. That was unfortunate. I know we did a whole test. We did the whole test beforehand, and it did work. So I'm not entirely sure why that happened. Narine, do you want to pull up the screen? You had it there while you were doing it. I think just before I kind of mess it up again. Maybe if you just
I
pull that
can
up, that would be
certainly
great.
do that again. You see, now I'm happy to be your driver. I was
Okay,
your
okay.
voice. Now be prepared to be your driver as well, but you can speak.
Okay.
All
Yeah,
right,
I don't
cool.
want to mess
So-
with the tech issues anymore. So okay. So I thank you for that, Narina. I'll be very quick because I think we've got a couple of minutes, and really just this fund was the first of its kind, launched in the market back in the middle of last year. So we brought the strategy to market in May. And Narina, I don't know if you've covered any of the kind of the objectives of the fund and the outcome objectives as to how we run it.
Not
But
all
very
that much.
similar
So
to-
that's why I've got you on the slide, sort of starting with the fund and then really sort of
Okay,
talking about
great.
the strategy of the fund. I think you can take over from there, Anton. Thanks.
Brilliant. So as Henk mentioned, I mean, very similar, we are looking to generate a CPI plus objective that's 2.5% net of fees over a rolling 3-year basis. And really in the end, the real thing around these strategies is to generate kind of above bond-like returns with less risk. So let's go onto the next one. Narina? Yeah, there we go. So the thing which is I think, Narina, you touched on it, which is so interesting about the way that we look at it, and I think slightly different to the way that Philip and Henk set out, is our starting point, given that this is the CPI plus objective, our starting point actually is inflation-linked bonds. So you can see here on this curve on the left-hand side, real yields in the South African market are extremely attractive. So inflation-linked bonds, a short-dated portfolio of inflation-linked bonds actually generates something like 5% return. So it's a real high bogey when you talk about portfolios. That's why we have a pretty decent exposure to short-dated inflation-linked bonds. And you can see this is the point that Phil made earlier. Actually, over that period of time, over the 10 years, that real yield has gone from below 1% now to above 5%. So it's a very high bogey for any other fixed income instruments to hold relative to real yields. And this kind of then goes on to the second point around our allocation. So we can, in this portfolio, hold up, in excess of 30% in credits. We like global credits, and I think you may have mentioned earlier on that this portfolio can invest, up to 30% in global credits. And the reason why that is because really the SA market is very illiquid. It's incredibly small. But really, most importantly, is spreads are very tight. So on this chart here, just by virtue of the supply demand, actually spreads in the local markets are at the all-time tights, and that's just given due to all the demand and lack of supply. And in the end, with fixed income, one of the most important things that you need to be careful of is that you can generate additional yield, but are you being paid to earn that additional yield? And unfortunately, in the local market, just given where spreads are, and given that the reality is we have default risk that we're not really, in our view, being compensated to hold credit in the portfolio. And in particular, when you compare that relative to what you can earn through short-dated inflation-linked bonds in the local market. The same, unfortunately, applies now in global markets. So we've seen really in the last year and a half, like we've seen in equities. So on the right-hand side there, you can see global spreads are now really kind of approaching their multi-year tights. They're not at the levels they were back going into 2008, but we're reaching levels kind of pre-COVID, and therefore the kind of the value opportunity in credit, both global and local, is extremely kind of limited. And I kind of think it kind of brings to the overriding point, if we just kind of finish off, because I know we kind of tight for time, is actually the great opportunity right now in the local market is you can still deliver inflation plus almost 5%. And I think it was Henk who said kind of almost equity-like returns. You can generate inflation plus kind of 4.95% returns without having to necessarily take on significant amounts of duration and credit risks in a portfolio. And for a portfolio where you're looking to try to generate 2.5 to 3, it is really attractive. So the need to go out there and reach for yield at this stage of the cycle, just given how far into the cycle that we are and how tight risk is, for us, we're running a very conservatively positioned portfolio to generate that return. So I managed to get 2 or 3 minutes in at the end of that. So I didn't do it justice, but thanks, Nerina, for covering my first half.
Excellent. Thank you very much, Anton. And yes, I'd like now the opportunity for us to bring all the panelists back and maybe to answer the audience questions. We've got some questions that have already come through, but if I can just encourage you once again, top left of your screen, there's a question box. Please do pose your questions in there for us. And I'm going to start off with what I think would probably be a very simple question. And you know what? I'm going to start with you, Philip, in terms of this one, because it almost takes us right back to the beginning of this again. Comes from Clive Fagan, who says, how does money market with compound growth compare to the type of income funds that the three of you were really talking about today?
That's a great question. And really, money market forms part of our universe. So money market are just your shorter dated bank type instruments predominantly. And then as you expand the term of that, you just get more and more yield. So if you go to a bank today and you say, listen, I've got R1 million, what's your call account rate? That's closer to money market. Three months, even up to 1 year is considered money market. A bond is like a glorified fixed deposit. It's just a listed fixed deposit. So today I can literally go and bought today, government 20-year fixed deposits at 13.21%. So it is literally a fixed deposit. So it's literally how long do you want to lock it away for? And if you fixed an interest rate, obviously you better be happy with that fixed rate because I've locked it in for 20 years. So it's really a case of money market is like a cash deposit in the bank, and it will go up and down with interest rates. If you want to fix your rates, there are longer dated instruments to do that.
I think a very good point. And maybe if I can follow on in terms of that question also, one of the major differences, of course, would be in terms of that potential for capital gain or capital loss, of course. And Philip, you showed us very clearly how in recent years, there really has not been any capital gains. Where we are now, and that's literally where I stopped you in your presentation, we are now hopefully poised at that point where rates are now rolling over. To what extent are one then foregoing the potential for capital gains from here on out by looking too much at where we've been in the past? And I guess, Anton, I'm going to ask you to come in after him to say, do we need to take on that additional risk of hoping for capital gains on top of the yield by actually moving up sort of outside of inflation-linked bonds and so on? So, Philip, Anton, if you can, between the two of you, maybe cover that for us.
So in the short term, you're going to see some volatility. You know, if I buy a fixed deposit today at 10% and I lock it in for 5 years and rates go up tomorrow, if I try to sell it back to the bank, they're going to give me less money. It's just a nature of it. But at the end of the day, it's like that fruits off the tree analogy. It's going to be about the yield. It's much less capital volatility than you see out of equity. So you tend to see, it's a bit like a rubber band. It stretches around, but it tends to come back again on the bonds over a period of time. And really, that's the thing to focus on. So like our portfolio is yielding 12.5% gross yield at the moment. That's like the speed of the car. That's the speed you're going at. All else equal over the next number of years in a similar interest rate environment, you're going to be getting a yield that's similar to that. It's not much more complex than that over time. So if you've got a time horizon of 12 months or longer and you're earning a very high income, you're drawing that off your, let's say your living annuity, or a client needs an income, it's a very powerful asset because you don't have to worry about the capital as much because the capital movement is largely noise. At the end of the day, I'm buying a fixed deposit. I put my R100 down. I'm getting my income at the end of the period. I'm getting my money back. And that's really the kind of instruments we're dealing with. And that's the nature of fixed income instruments are giving you a defined return and your money back at maturity.
Yeah. So Anton, do you think one needs to actually take on that risk? You showed how that those credit spreads are contracting even in the global market. For how long will what you get from your inflation-linked bonds be enough for you before you feel you need to move?
Well, I think the point really is around risk and around yields in the local market. Obviously, if you look at it from a historical perspective, you look at what you're earning in real yields, you look at what break-evens are assuming, it looks incredibly attractive, and it is incredibly attractive. But we're an emerging market with significant fiscal issues. And, you know, we know from precedent in many emerging markets, from Argentina to Turkey, etc., that yields can go to 50, 60. We can have significantly higher yields when you reach those types of levels. So it's it's unlikely. We kind of run a much more stable central bank and treasury, and hence, in terms of the overall duration, we actually at the maximum duration in our portfolio, we're getting close to 3 years. But we have to be, aware of the fact that there's no such thing as yield without risk, and extending that duration further and further introduces more volatility and more risk to the portfolio. And ultimately, the more you lock into that yield, the more you run inflation risk in the portfolio. So, it's not a question. I don't disagree with Phil around how attractive it is, but we have to just be conscious of, which I'm sure he is obviously conscious of, the fact that yields can go higher. They have gone higher, and spreads, on the other hand, they can go tighter, most certainly. But we are at a very late stage of the economic cycle, both locally and globally, and the opportunity to lock in those spreads at a much wider level is probably ahead of us. So that dynamic right now, it looks attractive to kind of run a low risk portfolio and try and match your risks with as low risk as possible. And a time will come where that does change, but it doesn't feel that we're at that stage of the cycle from our perspective.
All right. Henk, I'm going to pose the next question to you. It's an interesting question around the risk of investments in these interest-bearing fixed rate investments. And it's the question of how we measure risk, either from a volatility perspective or from a sort of risk of capital loss perspective. What you typically find is that a lot of your illiquid bank credit or those type of instruments appear to be very low risk because they're so stable, but it's just because they're illiquid. And so in traditional risk metrics, that could be picked up as a low risk exposure, but we know that obviously the default risk and the credit risk in those are a lot higher. How does one actually incorporate this in terms of your assessment of the riskiness of a particular income fund?
Yeah, and I think that's a very, very good question. It's actually a great question, and it's very topical. Philip earlier alluded to something that happened in our market not too long ago, where we saw quite a large default in this space for one of the sort of bigger income funds that had exposure to a counterparty, and that instrument was marked, as you said, very stably. It looked, by all metrics, a fantastic trade with no risk. And unfortunately, the next day you had to mark it down 50%. So for at the present, really, you have to think about the different risk premium that you want to harvest, right? And the multi-asset income space, as we've tried to show, is very diversified. And you have guys that play the duration bond market. You have guys who will play the inflation-linked space. And then you have people that go offshore. There's people who play more prefs, and then there's guys who would sort of use a mix of those different assets, which credit is one of them. So you need to think about what risk premium are the guys harvesting, and what should that sort of return profile look like. If it's more bonds, yes, you'll see a higher volatility, a higher heartbeat. Philip used a car analogy. It's about the journey, right? You'll have a couple of quick twists and turns around corners, but you'll get to your destination probably in one piece. Where in the credit side of things, it might seem a little bit easier to get to the top of the mountain, but the probability of falling off the mountain is a lot higher. But there's nothing wrong with using that strategy. Just understand that the risk you're getting yourself into is not necessarily what it says on the account and what the sort of volatility signature talks about. So it's not really about risk return expectations and understanding the manager that's putting those sort of instruments in a portfolio.
Henk, I'm going to go further on your car analogy, and I'm just going to say that for the ordinary investor, I think what we're really looking at here is ABS brakes. Because I, as a driver of a car with ABS brakes, don't need to know the technology behind how it works. All I need to know is that if I hit that brake pedal, my car is going to come to a standstill. So that's exactly why we have a professional, active managers sitting behind these that hopefully understand the technology that we as the investor might not understand. We're fast running out of time, but Anton, I just have to ask you a question regarding the hedging aspect on the offshore component in your income ETF, because that's also, I think, another interesting, unique feature about an actively managed ETF is that you do actually have the ability to not just do any form of hedging, but specifically currency hedging. Talk to us a little bit about that aspect, please.
Yeah, and in a fixed income portfolio, just given the point around capital stability and the shorter kind of time horizon of the investor, your volatility is something you want to minimize, and currency volatility, as we know, is something which can add a huge amount of volatility to the portfolio. So we will typically hedge all of our offshore exposure. And if we do run an unhedged part of it, it will be in the context of from a risk management perspective. So often running a dollar position in the portfolio does actually add to some risk diversification. But typically, Nerina, yes, the offshore exposure will be hedged, and we'll harvest the local carry in this market.
Great stuff, great stuff. Mike, I'm going to give you an opportunity to just close the session for us. I think maybe just a final word from my side before thanking our speakers is that I think one of the interesting aspects around the actively managed ETFs, and it was alluded to right in the beginning of Anton's presentation, is that it can be, this is an opportunity for even for more traditional index tracking ETF managers to offer a more efficient way of tracking an index rather than what is so restrictive in the more traditional so-called passive ETF. So for you, the viewers, I really want to encourage you to continue to explore the opportunity set within actively managed ETFs. We're in the early days. There's a lot more to come in this space. Thank you to Philip and to Henk and to Anton for taking us through tonight in terms of specifically on the quest for yield, the income side. Mike, back to you to close us off. Thank you.
Okay, thanks, Nerina. I was fascinated by that. I thought it was a great presentation by all three gentlemen, and I thought, and well done, Nerina, for doing half of Anton's presentation. In future we'll ask you to do the whole presentation, but I thought Nerina did a great job. Yeah, it's fascinating because you all offering products in the same market, but income has got so many assets and so many different types of exposures, from inflation linked to long-ended bonds, where you're getting much higher yield, but there's some element of volatility and risk, and to getting exposed to credit, bank credit, and so on. We've now got to look at the default risk. So I think it's fascinating what these income funds give you exposure to, and that the three of you have very different strategies in certain respects, in terms of Henk's 1.6 years duration, to Anton saying, well, we think 3-year paper on average is the place to be, to Philip saying, oh, go a lot longer than that, because you're getting rewarded by the yield. So I think what we really are left with is the fact that in this field, we probably need professional assistance. We need active managers to go out there and to analyze, do all the analysis of risk plus return plus the break-evens and so on, which perhaps we as individual investors can't do. But I do encourage, and I know there's quite a lot of retail investors listening to this seminar, don't just stick with very low-risk bank paper. I want to just buy a cash deposit which invests in 3-month paper. There's quite a lot of benefit from looking at going further along the yield curve, particularly in South Africa, where the yield curve is quite steep. And so I think these sort of products do give exposure to this asset class, and it's something that we haven't had up until now in the listed space. And I think it's fascinating that we now have got this exposure, and I think it's something that we need to keep coming back to. And I'd like to thank all the participants for their presentations, and thank you also to the audience for listening in. And we'll put this on. We'll put on a podcast so you can go back and look at it again. If you do have questions that you think of, get a hold of the Investment Analyst Society or ETFSA, and we'll pass them all directly with the speakers, and we'll pass it on to them. But I thought this was a great session, and thank you all so much for participating, and thank you, Nerina, for what you did to host it. And we look forward to welcome you all back to some future masterclasses in the near future. Thanks so much indeed, and good night to everybody.